to welcome everyone. We have an extremely special guest today, the co-founder and chairman of the Ether Machine, my friend Andrew Keys. And we have to do a bunch of full disclosure here, Andrew. First off, we became friends on the golf course. I was invited to speak at a family office conference in Puerto Rico, and you have a place down in Dorado. And I remember telling the host, they're like, "What do you need? We'll pay your full freight." I was like, "Look, I'll go down there and do this thing on one condition." They're like, "What's that?" I was like, "I want to play Dorado." And so it was, I had to fly down on Sunday. And I remember texting the guy on Saturday, like, "Where's my tea time?" I'm not getting on a plane without my tea time. So apparently he hit a text chain. Andrew said, "Oh, I'll take this guy out." And we clicked because for a number of reasons. Number one, just generally liked each other. But two, we grew up in New Jersey, fellow Jersey guys, a few towns away from each other. Three, golf addicts. Although I think I probably shot a 95 the first time we played together, and that's my litmus test. Because if someone invites me back to play after I embarrass myself, I know we're going to be great friends. And then over time, this is going back a few years now. You became a client of Great Hill Capital, which I'm very grateful, and it wasn't just a one-off. You've regularly added funds, and we're extremely grateful for that. And in full disclosure, I became an investor in the private placement of the Ether Machine, which I'm very excited about. And you have to know from my podcast, Hedge Fund Tips with Tom Hayes, I'm going to get a lot of blowback because they're going to say, "Wait, don't you buy companies that make hammers and building supplies and generators and airplanes?" And the answer is yes. This would be something kind of outside the mandate of what we do. But it's so interesting. And one of the key tenets of how I invest is I bet on the jockey. So this is an area that I know absolutely nothing. I mean, I know enough to get myself in trouble, but I'm not an expert in, but I wanted to participate. And I want that to be fully disclosed before we talk about this, because I think this is going to be extremely helpful. It's extremely timely, and people are going to want to know about it and then choose to do whatever they want with this information. But not to have it at this point in history, I think is probably a mistake for a lot of people. So with that said, Andrew, why don't you just share with our audience a little bit about your background before Ethereum? Because, we meet a lot of people who have become very successful in the crypto space, and it was
Sure.
just kind of like they bought something and it went up, and like here they are, they're successful. You were an extremely successful businessman before crypto. So talk to the audience a little bit about that.
Well, I'm still trying to figure out what I want to do when I grow up. So, it's an evolution. Well, first and foremost, thank you for having me, Tom. It's a pleasure to do this with you, and I appreciate the time you're spending with me. So, long story short, I sat at the intersection of the capital markets and technology for about 2 decades, and most prior to Ethereum, I built a revenue cycle management company in the healthcare space. So simply put, when you went to the doctor's office and you handed your insurance card and your driver's license to the person at the front desk, that information would get put into an electronic medical record and sent to Chennai, India, where that information would be shared with Blue Cross Blue Shield, United Healthcare, that's also in Chennai, India, and your demographics and your medical record would basically be approved for payment by a doctor. So basically, we managed the revenue cycle management of healthcare providers. And I basically learned everything that was wrong with payments and billing and insurance within a very specific vertical of healthcare.
Yeah.
And this happened kind of at the same time Bitcoin happened. And simply put, Bitcoin has been this interesting experiment in monetary theory. And there's one asset on the Bitcoin blockchain, a Bitcoin, and it can do one thing, which is to send. And I thought, well, that's cool that I can send you a Bitcoin without a bank in the middle, but there needs to be a much more sophisticated logic that underlies a transaction because the world's more sophisticated.
Yeah.
In my healthcare experience, you would have a medical doctor who was the provider, that would have a procedure done on a patient based on a diagnosis. So you had, if patient has healthcare insurance and premium has been paid, and patient has diagnosis that substantiates a procedure, then the doctor gets paid. So simply put, I use this as kind of a sector specific example. You had these if then else statements.
Yeah.
And really that it was the aha moment for me of Ethereum over Bitcoin. And Bitcoin was this opening act where there was one asset on it with one function, a Bitcoin being sent like a global abacus. But with Ethereum, we can tokenize any asset, a barrel of oil, a US dollar, a bar of gold,
Wow.
a parcel of real estate. And then we can embed those assets into digital legal agreements, these if then else statements, where our agreements are going from Microsoft Word documents into software code, these if then else statements called smart contracts.
Wow.
And basically I helped build the largest software company in the Ethereum ecosystem, a company called Consensus. And After that, I created a commodity pool operator and commodity trading advisor registered with the CFTC named Dharma, which is an acronym for Digital Asset Risk Management Advisors,
Okay.
that managed institutional scale of Ethereum.
Wow. Okay. So you have this healthcare business, you sell that, you get a liquidity event, and
Mhm.
then you start up Consensus, which is doing this programming, and that's how you come to be involved with Ethereum. Uh, do you meet the other players in Ethereum? You program some of this. What's going through your mind at the time? Do you buy the coin itself, or you're just
Yep.
involved in the development? Tell us a little bit about that. The
Yes
yeah.
to all of the above.
Okay.
So I went literally like a nerd to a meetup.com meetup, which was the first ever Ethereum meetup in Manhattan,
Wow.
at Cardozo Law School, which was held by a joint technologist and lawyer, who was a professor, named Aaron Wright, who's very prominent in the Ethereum ecosystem to this day. And he was hosting Joseph Lubin, who is one of the co-founders of the Ethereum project. And basically we had this discussion about, what would the internet look like? What would the world look like if we kind of took the peer-to-peer nature of Bitcoin, but created the ability to have any asset tokenized, and we could have a decentralized applications. So you could have kind of Uber without Uber sitting in the middle. You could have a smart contract that sits in the middle between a passenger and a driver, and you could have an insurer that creates a micro insurance policy just for that ride, and
Wow.
basically what would be the world, uh, if that were to occur. And
Okay.
so I helped build this company called Consensus. I helped Vitalik Buterin, who is really kind of the chief architect of Ethereum, uh, explain it to lay people, because he's a very technical person and very gifted. And really, kind of one of the fun stories, because we just came upon the 10-year anniversary of Ethereum. The first time Ether crossed $1, uh, it's now $3,500, I believe, or $3,700 today, uh, was when we created, I put a permissioned version of Ethereum on top of Azure, which is Microsoft's cloud, and basically created a concept of blockchain as a service,
Wow.
where institutions like JP Morgan, Microsoft, etc., could tokenize an asset. They could create a digital token that represented a stock, a bond, a security, and then could move those tokens and kind of expedite their trade settlement. Embed logic that says you can only move these assets if certain conditions occur. And basically, we released that news on the Wall Street Journal, and Ether crossed $1.
Wow. Wow. Okay. So explain, because you probably have a sense of my audience. I know you've tuned into the
Sure.
podcast from time to time. Explain Ethereum like you would to a 10-year-old. So,
Yep.
many people, including me, in my audience, don't have the expertise or understanding in crypto or blockchain. And in Puerto Rico, after we played, I remember sitting over breakfast. You explained to me how it parallels the internet in the 90s as this platform. And then all these apps were built upon the platform that became public companies in their own right. Apps meaning Amazon.com, Netscape, Google was an app built on the internet platform. All these pubcos, billions and trillions of dollars built on one platform. And you explained Ethereum to me like it's the next platform, and there will be apps built on Ethereum that go on to become huge public companies in itself. And that kind of clicked for me. I'm like, this is not just a coin where I'm hoping someone comes in behind me and pays more money for it. There's something unique and special here that I still don't understand, but this guy figured it out. Can you explain it to my audience in a similar way that you explained it to me? Because that blew my mind.
Sure. So it's interesting context because the way we'll explain it today is very reminiscent of thinking about, Amazon as a bookseller, 20 years ago.
Yeah.
And basically what I'd say is that I believe Ethereum to be the next generation of the internet.
Wow.
And there is no other substrate that can produce credibly neutral playing grounds for nation states, institutions, and individuals to trustlessly interact through. And so, what does that mean? Basically, we're evolving the internet from a place where 25 years ago we could basically read on the internet. And then with social media, we could read and write. And now, with this next generation of the internet, we're able to read, write, and own.
Hmm.
And that ownership is what Ethereum enables. And what that means is that we are going to have natively digital assets. All assets going forward are going to be represented as digital tokens. And these digital tokens can be anything from a stock, a bond, a derivative, a bar of gold, like a commodity, a barrel of oil, intellectual property, like art or music. And we can have logic that's embedded inside these assets. So imagine you and I are a rock band, and,
Yeah.
and you're the singer, and I'm the bass player, and it's just a two-person rock band. It's not a very fun rock band, but you're the good-looking guy, and I'm the ugly guy, and so basically we could have our own website, and every time we sell a song peer to peer with somebody else for $1, we could embed in this token that represents our song payment splits that says every time the song someone pays $1, because you're the good looking guy, you get 75%, and I'm the ugly bass player, I get 25. So we're able to kind of embed logic into these assets.
Huh.
And with that, what we're going to see is an expedited velocity of money where we're going to be able to see kind of constructs we've never been able to see before. An employment contract that gets paid by the minute, a real estate investment trust that could have 40,000 investors that can deploy capital, within days, and add arbitrarily complex logic. To take that, that example further, we had this asset that was a song where we had the 75-25 split. Now let's just take the same concept and turn it into a token that was a deed of a home. So if you and I own a house
Yeah.
and we have a mortgage on it that costs $1,000 and we wanted to rent the house uh, to somebody else that would pay us $2,000 a month, we could have this deed have a wallet, and every time the rent was paid to the wallet, we could have autonomous splits that says 1,000 gets paid to the mortgage,
Oh,
70, and then of the remaining 1,000, 75 could get paid to Tom and 25% could get paid to me. So basically, what we're seeing is kind of the intelligence of our assets. Uh, and so this is what Ethereum enables.
wow. So will the companies built upon on top of this, will they be the companies that enable simple people like me to, I go into this app that's built on Ethereum and I say, here, I'm uploading the asset, which is the digital song. And when people buy it, you send, $1,000 to Bank of America, send 2,000 to Andrew, and it will do it automatically. So companies that facilitate the use of that, or other type of companies built on Ethereum, like the companies that do the contracts and do the deeds and do the title insurance and do that type of stuff.
So what you as a user that's, let's call it not a computer scientist,
Yep.
should feel is that you basically should have the same user experience that we have now with, let's call it the legacy internet.
Okay.
You should see a thinning of the intermediary layer.
Got
So
it.
basically, there should be basically a value uh, price discovery mechanism for the value of intermediation between
Yeah.
counterparties of a transaction. And to that point, you'll see different players create different things. So like what you kind of referenced was, yes, there'll be like web designers and web developers that will make applications, but then there'll be just complete end user apps that we'll be able to enjoy. And I think the kind of the first one that we can reference is Circle, CRCL,
Yep.
just went public. Uh, and basically what this is the adoption of stablecoins, which I would say is kind of like the first real product market fit of Ethereum.
Yeah.
And what you're starting to see right now is when people go online to purchase things, they can pay with their American Express, Visa, MasterCard, or there's a button that says pay with a stablecoin. And the cost is 3% less because you don't have the credit card processing. And
Wow.
basically, you're just seeing a thinning of the price discovery mechanism for a payment processor.
So it removes the friction and Circle, which I don't know what the market cap is today. I'm assuming tens of billions of dollars already. So this is an example of a public company that would not exist if not for the new quote unquote internet platform, which is called Ethereum. That billions of dollars of equity creation is non-existent sans
Ethereum.
Ethereum.
Yeah. Yeah. There's very good data available, and it's by a financial accounting standards uh, board. The FASB deems high quality liquid assets. So things like dollars, stocks, bonds. So these are examples of HQLA, high quality liquid assets. And there are about $250 billion of high quality liquid assets, which is still very small.
Yeah.
But this kind of shows you where we are in terms of kind of the adoption life cycle. And there's $250 billion of high quality liquid assets on blockchains. And 90% of those high quality liquid assets are settled on Ethereum. And basically these are kind of
Wow.
parallel dynamics that I would akin to Google, where 90% plus of searches happen on Google, and then Ask Jeeves gets, one
Right.
tenth of 1%, Bing gets one tenth of 1%. Well, Tom, when was the last time you used Yahoo?
Yeah.
Or
Yeah.
and so what we're seeing, and there are technical reasons why Ethereum has this kind of hegemonic position. Ethereum has been able to create standards where basically anybody, whether they're a developer in Mumbai or Paris or San Francisco, can create a token based upon a token standard, and that token can go into a wallet. So basically, there's the ability for any engineer to kind of standardize these assets, and that's created a large adoption. There's also kind of robustness of the technology. So basically there's multiple implementations of Ethereum. So there's 9 different ones that have to form consensus and agree. So basically it can't go down. And then there's decentralization of the Ethereum network, which is the most decentralized protocol on Earth for this type of throughput. So
Wow.
basically, there are a few different reasons why it's kind of become hegemonic.
So it's almost like a network effect because 90% of these assets are on it. Everyone else has to be on it, and it just creates this cyclical effect. The other thing you mentioned about decentralization, I guess, was one of the questions I was going to ask. Again, not a computer scientist, so this can't be hacked because of the level of decentralization, and that you'd have to hack like a gazillion computers at the same time or something.
Right. So to your point, liquidity begets liquidity,
Yeah.
to your prior point. And secondarily, this is the only way that kind of nation states can trustlessly interact, at that like size and scale because there is such decentralization and there is this multi-client diversity.
Wow. Okay. I loved when you were on CNBC talking about the Ether machine and they asked you about Bitcoin versus Ethereum, and you said, "Why would I buy a landline when I could buy an iPhone?" I love this. Say more about that.
Yeah. So Bitcoin has one asset on it, a Bitcoin, and it has one function, which is to send. And if we're talking, to an investor base about TAM, there is a total addressable market of what I would call gold, which is kind of 22 trillion.
Yeah.
And Ethereum is the next generation of the internet where we can digitize any asset. So you can have literally any asset you can think of. We can create a natively digital version of it.
Wow.
And then we can do anything with it. So instead of just send, we can create these arbitrarily complex logic statements called smart contracts, which you can just kind of think of as digital if then else statements that can create infinite applications. So you could
Wow.
create decentralized Airbnb, decentralized Uber, decentralized Amazon, decentralized, so anything. And basically, what we're attempting to do is creating a price discovery mechanism for the value of intermediation. And
Wow.
and and the first example of this that's hit product market fit is stablecoins.
Yeah.
And because Ethereum settles over 85% of all stablecoins, uh, and there was just the Genius Act that passed 2 weeks ago, which gave clarity to stablecoin regulation. The largest beneficiary of the Genius Act is Ethereum.
Wow.
And so basically there isn't a stablecoin on Bitcoin. And so what I think is that Bitcoin was this great opening act of kind of teaching us that I could send you value like on a global abacus and I
Yeah.
can send you the bead, but basically we can only send the bead back and forth to each other.
Yeah.
Whereas with Ethereum, we can create any asset on it and then create any type of uh, digital legal agreement.
Yeah, I mean, my general instinct was always with Bitcoin, and it's basically been wrong, was that with Bitcoin, you're just waiting for someone to bid it up further, and it's worked. But my view was like, yeah, it's scarce, but there could be other just send type of instruments created. Whereas with Ethereum now, you have this kind of flywheel and literally practical daily uh, actions and contracts and tokenizations are happening on it. Therefore, there's real intrinsic value. And speaking to my next kind of question is, how are banks responding to the advent of Ethereum, and how does that play moving forward?
Yeah. So I think it's notable to recognize not a bank, but I would call it like early fast movers or competitors to bank. So I
Yeah.
would I would raise Coinbase, Robinhood, Kraken that's going to IPO in Q1 of 2026.
Okay.
These are, I would say, kind of like hybrid exchanges,
Yeah.
kind of like fintechs that also have crypto or crypto that have fintech aspirations. And basically, each one of those has created what's called a layer two scaling solution that settles to Ethereum. So Coinbase has created Base. Robinhood just created tokenized shares, and they didn't name it, but basically it's a layer two scaling solution that settles to Ethereum. Kraken has created Ink, which is another layer two scaling solution that settles to Ethereum. And so what we've seen is that kind of the fast movers that don't have kind of like the incumbent debt of being a systemically important bank over the last 20, 50, 100 years, like the bulge brackets, are able to kind of move very quickly.
Yeah.
And with the Genius Act passage, uh, literally only 2 weeks ago, we are in like a very interesting Cambrian explosion moment. I foresee that each one of these banks will likely A, create their own stablecoin,
Yeah.
B, create their own wallet. JP Morgan just announced that they're going to basically work with, their client Coinbase so that when you log into your Chase account, you can basically access your crypto assets that are sitting on Coinbase.
Yeah.
Uh, and so you're going to have this wallet, these stable coins, and you're going to have kind of a seamless user experience where kind of the pipes blur.
Yeah. Tell me, I got to ask one self-interest question, then I want to get to the Ether machine.
Sure.
So one of our holdings is we own PayPal. And PayPal is with Andrew Chris. Alex Chris is trying to be innovative, and you see, to your point, like you could send stable coins, you could pay with crypto. They're the sixth largest issuer of stable coins, so they're kind of on the cutting edge of this. How will they be helped or hurt by these developments, in your view?
Well, so I think that PayPal is interesting in the sense that you nailed it. They have been one of the first movers. They have a top 10 stable coin.
Yeah.
That said, their business is to kind of sit as an intermediary
Yeah.
between, counterparties.
Yeah.
Uh, I kind of gave like the technical devil's advocate or a proponent to, the thinning of the intermediary layer. But
Yeah.
there are kind of fundamental add values that a company like PayPal has, like let's call it like the global regulatory compliance that they have, in 100 different jurisdictions. Like that money transmission business, I think is something that they're going to have kind of incumbent upon them. But I think that you're gonna see a thinning
Yeah.
PayPal, MasterCard, Amex, where you're able to do this. And basically, the AML KYC is going to be done at the identity layer instead of at the intermediary layer. So
I see.
basically, in order to transact, you're going to have your wallet that is the Tom wallet, not the
Yeah.
PayPal wallet,
Yeah.
and KYC approved. And basically, you'll have to have attributes about yourselves. So facts about yourself. Maybe it's your bank statement or your mortgage that deems exactly where you live for AML KYC, and then like attributes about yourself, or excuse me, attestations about yourself. So like your reputation. Does Tom have good credit? Is Tom good in different transactions? And then you're going to have this self-sovereign digital identity where it's owned by the individual rather than owned by the intermediary. So, a good example of this is if you take 10,000 Ubers and you get 5 stars because you are a gentleman and you want to go rent an Airbnb, that reputation of your 10,000 5-star transactions is not portable. And I
Yeah.
bet if you take 10,000 nice Ubers, uh, when you go to rent your Airbnb, you'd probably be a pretty good tenant
Yeah.
of the house. But that reputational attribute doesn't kind of sit with you. So what we're going to see is this technology creates a self-sovereign based internet rather than logging into Facebook or logging into PayPal or logging into these other apps. We're going to start seeing the user have more sovereignty and
Yeah.
power.
So I think the way to think about it, and correct me if I'm wrong, is like the PayPals that have networks of 438 million people in the short term, they're going to benefit from this transition in that they're the first mover, and that if I want to pay for something with stablecoin or crypto or whatever, it's there. So for like the next 3 years, they're going to be like the innovator. When we look 4 or 5 years out, they're going to have margin compression as they're whittled away, and by then we'll be out at a double. So on to the next. All right, now to the Ethereum machine. Why we're here? Explain why you set it up, how you set up,
Yep.
and what it does and what it can become.
Great. So with before explaining the Ether machine, we have to just kind of touch on a little aspect to Ether, the
Yep.
asset. So we talked about Ethereum, this next generation substrate of the internet, and basically for every computational step, it requires a micropayment of a digital oil or digital fuel called Ether. And part of this is that with Bitcoin, the way that the network is secured is through what's called proof of work, which simply put is actors have to spend money on real estate, hardware, and electricity to solve math problems to basically validate transactions. So basically, if you wanted to be a Bitcoin miner, you would have to spend money on hardware, real estate, and electricity, and then you could solve math problems and then get rewarded in Bitcoin. Ethereum works a little bit differently, and it works through what's called proof of stake. And what this does is Ethereum doesn't need hardware, real estate, and electricity, but one needs a stake or basically to post a bond and then to validate a transaction. And this is kind of a technical feat, and then they are generated in yield in Ether. So where Bitcoin is kind of unproductive, this digital gold asset, Ether is productive, A, in the sense that one needs it like oil for these transactions, and two, in the sense that it can generate its own intrinsic yield.
Mm,
When going through, how does a public market participant that's not necessarily a computer scientist get exposure to this asset? There are different kind of thought processes that one could think about. So first and foremost, there are ETFs.
yeah.
And right now in America, and it's mostly a relic of the Gensler era, the ETFs do not have the yield that Ether generates through proof of stake. And that's like basically buying a stock that has a dividend, but not availing yourself to the dividend.
Wow.
We do think that in time they will have the ability to stake. But if we look at the ETPs in Canada or Europe as a proxy, what we're seeing is that the ETPs can only stake at 50% capacity. And so
Mm,
that means if you have $1 billion in a Canadian ETP, they're only staking 50%, which is 500 million.
yeah.
And on that, they're only earning what I would call the vanilla yield, which is basically kind of the floor yield, which is about 3% on half of the assets. So it's really on the $1 billion, you're earning 1.5%.
Right.
And with this vehicle, we're able to, and the reason why that happens is it's a technical nuance. And without boring everybody, if one were to unstake their ether today, it would take a couple days to get one's ether back. But
Yeah.
if God forbid a black swan event were to happen in the world
Yeah.
and 50% of stakers wanted to unstake at the same time,
Yeah.
a couple days would grow from to 6 months or a year.
Yeah.
And so that doesn't jive well with the 24-hour redemption requirements of ETPs,
Ah,
ETFs. And so and this is denominated in Ether. It's not even dollar denominated. So
yeah.
you can't like underwrite this or insure it or market make it. You just basically can only stake at 50% capacity.
Okay.
So first and foremost, in the ETFs, you would basically be staking at 50% capacity.
Yeah.
And there are other things that we can do. And that's really kind of one of three buckets of
Okay.
active management of this asset, which is so the first is staking. And then the next is what's called restaking, where you can use Ethereum's proof of stake protocol and use it to secure other networks. And we could add additional yield that way. And then there's this decentralized financial economy that's been put on top of Ethereum, this $250 billion economy that will be growing to trillions
Yeah.
over the next decades. And you can use Ether as, let's call it pristine collateral, and you can earn additional yield there. So where the ETFs back of the napkin are earning, 1.5%, we believe we can materially outperform that by employing active risk management. And so we think that this is the right vehicle, a public operating company is the right vehicle to actively manage Ether. And then there's kind of two paths to go by. One could deploy into a shell company,
Yeah.
which is done via reverse takeover, or the vehicle we chose, which is a SPAC.
Yeah.
So simply put, I anchored this vehicle with my own personal balance sheet, and I'm deploying $645 million of Ether into this
Yeah.
because I wouldn't suggest anyone else do something that I'm not willing to do myself, and
Yeah.
I want to lead by example. That's
Yeah.
about 15 times any other vehicle in the space in terms of a founder's commitment.
Wow.
And
So all these other guys that are in the same space but not able to generate the same yield that you've been doing at Dharma, by the way. It's not like you're like, oh, I have this idea how we can get more yield. You've
right,
actually been doing it for
and it's
years with your own capital, and now you're deploying. And 600 million sounds like an enormous amount of money, but it's a minority for you. I mean, but it's material. And that's a critical thing that I look for in management. What skin do they have in the game? And number one, I co-invested because I like you and we're friends and I'm betting on the jockey. But two, it's like he's putting a real, I mean, significant amount of money in his own idea. So talk a little bit about how that differentiates you from the other players in it, and then we can talk about how people can find it and learn more.
Yeah. So simply put, I started looking at this from first principles, and I said, if I wanted to deploy capital, so I was already doing this in a private context, but basically the difference is now in a public vehicle, I'm able to access the public equity markets and the public debt markets, right?
Yeah.
So I could basically borrow to acquire more ether, or I could sell equity to acquire more ether. And when I started looking at it, there was, generally speaking, two ways to do this. One would be I could reverse take over a dying, pick your poison, a dying biotech, a
Yeah.
dying gambling company, a
Yeah.
dying Bitcoin miner, some dying microcap that had a pre-existing operating business, pre-existing liabilities, pre-existing management that I would still have to pay. All of that, I wanted pure play exposure to Ethereum and to be able to choose my operating team and solely focus on that. I didn't want to have a shadow management team, shadow liabilities, shadow debts, have 80% exposure to Ethereum and 20% to this pre-existing operating business.
Yeah.
Uh, and so we went down the route of creating a de novo entity, so a
Wow.
brand new LLC where we've anchored with capital, and then basically that will go through a business combination with a special purpose acquisition company that has no pre-existing operating company to deal with, and then basically this is the sole pure play exposure to Ethereum and Ether denominated yield, where we have chosen, handpicked our management team which are essentially the Avengers of Ethereum, the best in class operators, uh, to actively manage this risk for institutional and Main Street investors. And we just completed a capital raise in the form of a private placement and a pipe.
Yeah.
It is the largest common equity raise in the last 5 years. So
Wow.
over $1.5 billion. And
Wow.
and the market has agreed with us. And so now there's exposure available through the ticker DYNX, uh,
Okay.
which is Dynamics
Okay.
Corporation. And that is going to We are going through the SEC S4 registration right now, and basically in a couple months, that will evolve into the Ether Machine Inc.
Okay.
And we will have an active operating business of acquiring and professionally managing Ether.
That's amazing. And if you look at MicroStrategy as an example, Ethereum is still scarce, right? Like Bitcoin.
Yep.
So there's that. He's been able to, in the MicroStrategy vehicle, which he still has the operating company, but whatever, issue a lot of low cost debt and converts to buy up more of this scarce resource that only has that one value you said of send, whereas yours has unlimited values of banks and stable coins. And I look at stable coins because it's going from 250 billion to 2 trillion demand, which is going to lower rates, which helps my housing plays. So I think of it in a different thing, but it's going to help demand for treasuries. It's also going to be the productivity is going to be deflationary, and all that, taking the friction out, increasing the velocity, like what you said. Um, so I think of it in that term. Are you guys thinking of in the scheme of what Michael Saylor is doing, or maybe like a more conservative version of that to accumulate at the right times and the right prices? So like you can issue equity. Let's say if Ethereum doubles in 2 months, and you say, this is a little ahead of itself. Now's the time to issue equity. Or if capital's cheap, rates go down, let's issue debt because that makes sense. How do you guys think about that?
So great question. What I'd say is that broadly speaking, MSTR pioneered what I would consider a positive sum game, where they were able to issue convertible debt to hedge funds acquiring volatility. And they would basically use that convertible debt or the proceeds of that to buy the underlying asset, in their case, Bitcoin, for shareholders that wanted Bitcoin exposure leveraged.
Yep.
And and I think that the devil's in the details, and there is kind of nuance to this. But I think that this is a way to actively manage risk around the public debt markets efficiently.
Yep.
And to your equity part of the equation, I think that one needs to understand that these assets can trade at a multiple to NAV or an
Yeah.
MNAV,
Yeah.
and and MicroStrategy just recently came out and said that if there is a MNAV of the MicroStrategy stock that's greater than 4, they would aggressively sell equity.
Yeah.
If it's between 2.5 to 4, they would opportunistically sell equity. If it's under 2.5 times, they would not sell equity because that gets to a point where it starts being dilutive to shareholders rather than accretive.
Yeah.
And we will be similarly opportunistic.
Yeah.
And my whole benchmark of this vehicle is ether concentration per share, meaning I will only, as patient zero, as the largest shareholder, as someone who wants to lead by example and not suggest anyone do something that I wouldn't do myself, I will be maniacally focused on accretive ways to access the public equity and debt markets. And it's
Yeah.
market dependent. Uh, and with that said, we'll be relying more on the debt markets than the equity markets. And furthermore,
Love it.
this is another reason why we went with this de novo entity. So when you have to underwrite, counterparties, let's call it the hedge fund world, let's AQR, Jane Street, Millennium, etc. That could be your convertible bond issuing counterparty. They're going to underwrite each one of these vehicles. And I think they'd rather underwrite something de novo with no legacy liabilities, no
Yeah.
legacy operating companies, no legacy governance, no legacy management team where you're going to have this kind of leakage, versus, something that's clean. And so we think that for the, let's call it medium to long term, this is the right vehicle to do so.
Yeah, and the other thing that is just crossing my mind as I'm thinking about all this is the spread arbitrage. So in Bitcoin, you don't have that. What you have is a bet that people are going to pay you more for a scarce send only asset. Whereas in Ethereum, you're betting on the flywheel of more and more usage based on more stablecoin, based on more applications, et cetera. But the three buckets that you talked about in terms of generating yield, it's very easy to, it will be very easy at certain points in the marketplace to issue debt with a yield lower than a conservative yield you can generate on an ongoing basis, which implies if you're maximizing a balance sheet, you can be aggressive at certain points when the spread is wide, because not issuing at those points in time would be bad for all shareholders, but namely you as the largest, right? Why wouldn't you take that spread all day long if the yield that you can generate is with conservatism is meaningfully higher than what you pay for that debt?
Right. So you absolutely nailed it. I mean, I think bottom line is this is a better treasury asset than Bitcoin due to the yield that could, conceivably could pay that zero coupon indefinitely.
Yeah.
And PS, it's double the vol of Bitcoin.
Yeah.
So, there's another carrot in there for the volatility-seeking hedge funds
Yeah.
that are buying the convertible bonds. So not only does it generate that yield, it has double the volatility.
And then last question, will you ever use this, I guess never say never, like as a Berkshire of Ethereum applications, meaning you got all this yield coming in, you got this appreciation, you have access to the capital markets. Would you ever look at like, hey, the next circle that's going to be a application on top of Ethereum, and you're like, this is a slam dunk. We want to participate as the premier Ethereum reserve machine. We want to participate in that because we know that's going to be a five bagger or whatever. Do we take some of that yield and buy equity in some of these things on top of it? Or is that not in the immediate plans and open for discussion in the future kind of thing?
So what I would start with,
Yeah.
well, first and foremost, we've got to start with getting the S4 registration done and getting us out the door, right?
Yeah, of course.
And with that said, afterwards, our CEO was the head of M&A for Consensus
Oh,
and
wow.
basically was able to do 10 acquisitions in the last 5 years for Consensus, which is the largest software engineering shop in the Ethereum ecosystem with illiquid private company stock.
Uh,
And now he's going to have public stock that we could do bolt-on acquisitions that we would deem cash flow accretive.
wow.
And with that said, we would start with Ether generating yield accretive acquisitions potentially.
Yeah.
And so what I mean is that there are custodians that we could acquire that get paid in Ether for custodying assets that we could use. There are staking companies that we can acquire that get paid in Ether for staking. And then as time evolves, we could consider having other types of M&A that wouldn't necessarily be completely Ether denominated, but could add to the enterprise value as the space matures. And I
Wow.
think that there's kind of a crawl, walk, run, or a short, medium, long term, however you want to kind of phrase your cliche of what this vehicle can be. And I think that that'll be up to kind of market dependent and shareholder dependent. And we're going to work with our shareholders on kind of the meritocratic best way forward.
Yeah. Okay. This has been fantastic. First off, want to just disclaim once again for everyone: this is not a solicitation. This is opinion, not advice. Educational purposes, entertainment purposes. Go to hedgefundtips.com, click on terms. That said, how can listeners find out more and make a determination with their financial advisors whether they want to be involved or not? How can they get information? How can they educate themselves? And anything else you want to close out with?
Sure. So our website is theethermachine.com and our ticker is DYNX on NASDAQ.
Fantastic. Well, thanks so much, Andrew. This was just a wonderful experience. I learned so much listening to this. I think my audience is going to learn a lot listening to this, and we wish you incredible success.
Thank you.